Today's episode is sponsored by A3 Environmental, a Midwest-based environmental consultancy firm. With 19 years of experience and 25 scientists across the country, they have both the experience and the resources. A3 specializes in environmental due diligence. They are frequently hired by banks, private equity groups, property buyers and sellers, and M&A attorneys. Recently heard of a situation that A3 got involved in where a bank and a buyer had ordered an environmental report. And when the environmental report came back, the seller looked at it and he was somewhat suspect to what the findings were. And he actually hired A3 to come in and refute some of those findings with the other environmental firm. And at the end of the day, A3 was able to find some faulty findings and got the report thrown out and a clear to close for the seller. And they were able to get to the closing table. So they've really got the right resources and the right people. So if your acquisition is in the industrial space, automotive or dry cleaning or plating, and the deal includes tanks or tubs, vats, drums, silos, or storage of any sort of hazardous chemicals, you'll definitely want A3 on your M&A team. Their motto is A3 Environmental Consulting, buy assets, not liabilities. Hope you enjoyed today's episode.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
M&A Unplugged community, we are in for a real treat today. We are being joined by Geoff Cockrell, who is the head of the private equity practice for McGuireWoods, a premier law firm with a stellar 185-year track record and operations in 26 countries. Geoff has built an incredible practice representing private equity sponsors, strategic purchasers, and sellers across a broad range of industries. He has clearly become a go-to resource for private equity mergers and acquisitions, and I look forward to unpacking his knowledge. I'm especially excited because so many of our smaller and lower middle market clients are somewhat mystified about private equity and whether or not their companies would be of interest to private equity groups. Geoff, thank you so much for joining me today. So happy to have you here.
Happy to be here.
So Geoff, why don't we start with, if you could talk to the M&A Unplugged community about your practice, what you do, a little bit about McGuireWoods, and then we'll sort of dive into private equity and the types of transactions that they do and what they look for.
Sure. As you mentioned, I'm the head of the private equity group here at McGuireWoods. McGuireWoods has about 1,100 lawyers spread out across the country, representing all sorts of clients and all sorts of things. I principally represent private equity funds and kind of acquisitions of portfolio companies, and those all tend to be kind of middle market, lower middle market platforms, which might range from an enterprise value of 10 to $300 million. And then once a platform is acquired, many of them, their growth strategy is through acquisitions. And so they'll be doing all sorts of acquisitions that could be anywhere from $1 or $2 million acquisitions up to $50 million acquisitions or more. But I spent a lot of time doing mergers and acquisitions for private equity funds.
That's great. So how did you wind up focusing on this area? Because when I read through your background, that's not where you started, right? So you've sort of worked your way over to private equity, and now you've been doing this for a while.
Yeah, I've I've always been kind of a knuckle dragging M&A lawyer, and that can be in a lot of different contexts. Private equity work is really just M&A work on a little bit of adrenaline. And like many things in the law, your career kind of follows where the work is and where you've had some success in building that. And that kind of oriented towards private equity. And then within that, McGuireWoods has a really big and strong healthcare group. I mean, I've gravitated towards doing more healthcare transactions, but all of it is M&A related. And wherever I can kind of cobble together some sector expertise, that usually helps in building a practice.
Yeah, I'm so excited, as I mentioned in the intro, about getting into your work and really unpacking some key nuggets for the audience. But let's start with demystifying private equity. So many people, I think, have improper perceptions of private equity. So maybe could you break down private equity for the audience, and what does that really mean?
Yeah, private equity really is just kind of pools of capital that are going to buy and grow businesses. So, whether that is capital that's pooled from pension funds or wealthy families, private equity funds will pull together this pool of capital and then buy and build companies. Private equity sometimes gets a bad rap on television or in the media that their business is buying things and then chopping them up. That's not really been the experience of what I've seen. They generally will come in and buy a company and then build it as quickly as they can, but very much growth oriented by and large.
And I think there are flavors of private equity group, and they get sort of morphed together, and they really shouldn't be lumped together. I'm specifically talking about the difference maybe between private equity groups, family offices, and fundless sponsors, independent sponsors who have really exploded over the last 5 to 7 years. Could you talk a little bit about the differences between those groups of buyers?
Sure. Private equity fund, again, is a pool of capital that it generally has a 10-year lifespan. So pension funds and other institutional investors will commit capital to this private equity fund for the purpose of buying and building companies, but they tend to have a limited lifespan. So a private equity fund is usually buying a company with the idea of building it over the next 3 to 5 years and then selling it, maybe to a strategic buyer, maybe to a larger private equity fund, but their general idea is to keep it for a limited period of time because they're ultimately returning capital to their investors over the 10-year life of the fund. Family office is like you might expect. It's a very wealthy family or a group of wealthy families that they've made their money doing whatever. Now they have this enormous pool of capital, and they might be investors in private equity funds. They also might be direct investors where they could acquire companies directly. There's some key differences with family offices. One of them being that they are less likely to need a limited duration investment. So family office might have the intention of kind of buying companies and holding them pretty much indefinitely, whereas a private equity fund is going to be built to sell that company in 3 to 5 years. So there's some key distinctions. Independent sponsors or fundless sponsors, you might think about it as more like private equity. So a private equity fund has their pool of capital, and if they're going to buy a company, they'll be putting in some of their dollars as equity and then borrowing money from a bank or other lender to kind of fund the acquisition. An independent sponsor is doing the same thing, but they don't have the pool of capital. So if an independent sponsor is looking to acquire a company, they'd kind of go about it in the same way that the private equity fund would, in that they would enter into a letter of intent with the target. But then the independent sponsor has to turn around and source not just the debt to fund the acquisition, but also source the equity. There was a time when independent sponsors and fundless sponsors were a little bit more in the backwaters of the M&A community. They've really kind of come to their own and become very credible and very much more established, and capital providers are much more ready to work with them. So an independent sponsor is also a very viable acquisition source.
Geoff, when you talk about independent sponsors, I'm just like private equity groups, not all are created equal. Are there things that sellers should be looking for in an independent sponsor that separates them from the rest of the pack?
Sure. Sellers often think of independent sponsors specifically in evaluating kind of their execution risk of how likely are they going to be able to get to the closing with all of the capital to complete the transaction. Since, like I said, they don't have the equity portion of the purchase price already built into a fund. They have to go secure it. So there's two things if I were a seller that I'd be looking at. And by no means should independent sponsors be kind of disqualified as viable buyers. But if I were a seller, I'd be looking at two things. One is kind of where are they going to get the capital from and how close are they to that capital? Meaning, have they already had conversations? Have they done transactions with capital providers in the past? Just really evaluating how secure the capital is that it's going to be able to show up at the closing. And then secondly, kind of looking at their track record of having gotten to closing, because what you probably don't want to do is enter into a letter of intent with an independent sponsor that's going to have difficulty putting together the capital to close the deal.
That's great advice. It's great advice. So switching back over to the private equity world, are you seeing any trends that have appeared or emerged in the last 6 to 12 months or maybe even longer that have surprised you, or trends that you didn't think were going to stick but are sticking?
Like I said, I do a lot of healthcare deals, and the pricing on healthcare platforms has just been white hot. Almost difficult to imagine multiples. 12, 13, 14 times trailing EBITDA are not completely uncommon. That's just a lot to pay for an acquisition and puts lots of pressure on kind of quickly growing it. So the pricing has been, I think, a little surprising how long it has stayed this high, and partly that's just an immense availability of capital. There's a lot of equity dollars available in private equity and in the hands of strategics. The interest rates continue to be very low, so the debt financing is very, very available, and I think there's just an immense amount of capital chasing a limited number of deals. How long that continues, it's hard to know, but that's probably been the most surprising thing over the last 12 months.
Geoff, are you seeing those sorts of multiples on add-ons as well as platforms, or that's really just those multiples apply to platforms and add-on multiples are probably at a different level?
They'd be at a very different level. A platform has kind of an altogether different kind of pricing around it. And as you scale up, part of why private equity funds enter this arena in the first place is that smaller things cost less as a multiple of EBITDA, and larger things cost more. And so, if you can buy one or many smaller things and kind of put them together and integrate them, you'll creep up into higher multiples of EBITDA just by building scale. Is one of the ways that they make money. Certainly not the only way, but that kind of multiple arbitrage is part of the model.
Yeah, that's great. So let's move away from price for a little bit and let's talk about what private equity groups covet in a target. What are the things that, a private equity group, analyzes a business? What are the things that pop out that private equity groups just, they love to see, the soft issues, the operational issues, that sort of stuff?
It probably depends if you're talking about a target that is a platform that they're going to build around versus an add-on acquisition. In an add-on acquisition, they probably have fewer needs from that target, meaning the target may have kind of incomplete infrastructure. It may have more challenging contracts, but if they were to acquire that add-on acquisition, they'd be pulling it onto their platform, which has its own infrastructure, maybe its own contracts already in place. And so they can deal with a less built-out entity, which is partially why smaller companies trade at lower multiples, is they don't usually have all of that infrastructure. Whereas a larger platform or a larger target that is intended to be the platform itself, it's usually needs to be more built out in the sense of infrastructure and personnel, or the private equity fund may be bringing the personnel, but it needs to be a more established business. And in that context, they're usually looking for either a company in an area where there are a lot of things to buy, meaning if I'm a private equity fund and I can buy a platform and then I can see a pathway to buying a bunch of other things, that's one way to make it grow. Or if there's an impediment to the growth, that is something that they can solve. Take an aging family owner that has kind of limitations in what their skill set is as far as taking the company to the next level. So bringing in more professional management, that might be an impediment they could solve. Or there may be a growth strategy that the company just doesn't have the capital to execute on. The private equity fund obviously has a lot of capital. They can help solve those impediments. So identifying targets where there's kind of problems that they know they can solve.
Yeah. So, Geoff, many of the listeners in the M&A Unplugged podcast community are owners of businesses. Probably most would be considered add-ons, but there's a bunch out there that are platforms as well. If you could take a minute to talk directly to those owners and advise them on things that they should do or know about if they're going to engage with private equity groups, what advice would you offer to those owners?
I think the first advice and the earliest advice would be to kind of assess your tax structural situation. It's not at all uncommon for, by the time I'm arriving on the scene, where maybe there's a letter of intent already executed, or you're in the midst of kind of arriving at a transaction with a buyer, where we'll encounter problems with the target, and they may be problems if it's maybe a C corp where you're trying to solve for two levels of tax at the corporate and in the individual level, or you may be trying to solve for a problem where you've got three owners and then two other people that probably should have been owners but aren't, but you're wanting to get them kind of some of the proceeds in the transaction, but you're going to have a tax challenge in getting there. And for a lot of tax problems, there are solutions to them, but those solutions need some distance from when the transaction is occurring. And you may have some ability to fix things that are there, but your ability to fix them is going to quickly be going away as you get closer and closer to the transaction. So the first advice I would get is figure out if you have a tax problem and figure that out right away, and figure out if there's any way for you to solve that problem before you get too close to the transaction event, would be my first advice.
That's great. Awesome advice. And to the M&A Unplugged community, my suggestion is you figure that out before you ever go to market. Work with your accountants or hire a specialist that can help you look at the potential deal structures and what we call your net walkaway will be. That will inform you as to whether or not now is the right time. And I will also caution you that you really need to make sure that you're working with advisors that understand M&A transactions, because as Geoff's alluding to, there are lots of creative solutions to fixing, a tax issue. And so that's where people who do this day in, day out really matter. Geoff, are there other items that you would recommend to owners who are going to engage with private equity groups?
You might think about figuring out if your financial reporting is kind of up to snuff, because any buyer is going to need to kind of understand the economics of your business, and many sellers are operating on a looser framework. Many of them are cash basis taxpayers, which is not problematic in and of itself, but can create some kind of friction in getting from the starting point to the ending point. So figure out if there are some improvements that could be made in your kind of financial reporting so that your financial statements are a little tighter, because the looseness in them is going to create challenges down the road in the transaction.
Yeah, Geoff, I had Tad Render on a couple of weeks ago. He's the head of the transaction services group over at Miller Cooper. And he talked about how often the balance sheet becomes such an issue in these transactions where, people are just not properly accounting for things. Inventory, oftentimes a very big issue, and not really understanding the concepts around net working capital and really what's going to be transferred with the business. I'm assuming that that's a lot of the stuff that you're talking about.
For sure, because the valuation, the typical understanding of valuation from a buyer is, if I'm going to pay, let's say, $10 million for your company, what the buyer means in that is that I'm going to pay $10 million for your company and it's going to have no debt on it. So if there's any debt, that gets paid out of the proceeds. There's going to be no cash in it, which means you can take the cash, which that's a plus. But, and here's where it gets sometimes difficult. The $10 million assumes that you are going to deliver to me a normal level of working capital. And I'm going to get that normal level of working capital. And figuring out what that normal level is, it can be slippery if you don't have historical accrual balance sheet. Plus, there are many sellers who kind of have in their own mind the idea that if I close on December 31, all the accounts receivable that are there belong to me because those are pre-closing. And that's not a crazy thought, but that's not usually how valuations work. The buyer's expecting the delivery of a normal level of working capital, which is going to be normal level of accounts receivable, a normal level of inventory, a normal level of accounts payable. And figuring that out is, you can do a lot of brain damage to navigate to that answer.
Yeah, that's great. So let's talk about how private equity groups approach financing of transactions. And I know there's not one size fits all, right? I mean, every deal is different, but if you could talk at a high level about how private equity groups put together the debt and the equity, and what that looks like in a typical deal, I think that'd be very helpful.
There are different schools of thought on how much leverage is appropriate. And at certain level, a seller may have less interest in that topic, meaning if I'm selling it for all cash, how the buyer wants to finance the company going forward is their business. If, on the other hand, the seller is rolling over a significant portion of their proceeds into the go forward company, the amount of debt impacts the seller, both in terms of kind of the risk profile of the company going forward, meaning that more debt has the potential for more risk, but more debt also has the potential for more higher returns. So if I have $10 million company and I'm rolling over $1 million, so 10% of my proceeds, I may be rolling into more than 10% of the buyer, because the private equity fund may be putting in $3 million of its own money, and you're rolling in 1 million. That leaves 6 million that they're financing from a bank. But your 1 million, which is 10% of your proceeds, is now rolling into a 25% interest in the buyer. So debt has both risk and enhanced upside, because that same math, if they only borrowed 3 million, so they've got 6 million of equity and your 1 million of rollover, you're going to own a much smaller percentage of the company on account of that. So debt has pluses and minuses all the way around.
And that's a trend that we've seen just in the deals that we've done. We've seen really pick up steam over the last 3 to 5 years. We've seen more private equity groups coming in and talking about rollover equity, even in add-ons. We've seen that, and that's great. It could be a potentially great outcome for owners who don't want to walk away from the business and continue to have some skin in the game.
Yeah, and I would say on a platform, the typical expectation of a buyer is that the seller is going to roll over into a 20 to 30% interest in the buyer. That doesn't mean they're going to, for the same reasons of the impact of debt, that doesn't mean that the seller is rolling over 20 to 30% of its proceeds, but it's going to be rolling over some of its proceeds that are going to represent 20 to 30% of the buyer. That would be a fairly typical expectation in a platform acquisition. A add-on acquisition, it can be a little bit more mixed. Smaller add-ons tend to be more all cash. Larger add-ons tend to have more rollover potential. Some private equity funds want sellers to do more rollover. Some private equity funds want sellers to do less rollover. So as you're talking to potential private equity buyers, that should be a topic to make sure your kind of ideas and interests are aligned.
So, Geoff, aside from price and how a deal gets financed, are there some deal terms that you see people getting tripped up by oftentimes? And what would your advice be around those deal terms?
The folks often, like you said, the importance is the amount you're going to walk away with in the sale. But I'd go a step further. It's not just the price you get; it's the price you keep, which kind of sends you down the pathway of indemnification exposure. When you sell a company, the price has some built-in assumptions, and one of those assumptions is that things are not all messed up in the company. And the way that that gets teased out is, number one, the buyer's going to be doing diligence and looking at things and kicking the tires, as you might expect. But that's not all it means. It also means the buyer is going to be presenting you with a contract that makes you represent a bunch of things about the company, which are basically at varying levels having you tell the buyer that things are not all messed up. And that is going to connect to indemnification obligations. But what I would say is that those tend to not be kind of wide open exposures, meaning it wouldn't be crazy to think about indemnification as, well, whatever happened on my watch is my responsibility, and whatever's going to happen on your watch is your responsibility. That's not generally how it works out. The market has kind of arrived at some answers on how much exposure the seller is going to take, and that usually surrounds ideas of, my representations are only going to last so long. An escrow that I might have to put to support those indemnification obligations is only going to be so big. My maximum exposure on any of these ideas is only going to be so big. And so part of the exercise for a seller is to know what the kind of the market ranges on those topics are. And number one, not let yourself be pushed into a corner that your indemnification exposure is greater than those market tolerances. But number two, not be asking for limits on that exposure that are outside of those kind of market tolerances. So a market deal is ultimately what you're going to get, and knowing what that means and arriving at it as quickly as possible is the best approach.
Yeah, we could unpack this one topic and spend another 30 minutes just talking about this, right? Because there's just so much meat on that bone, and we just don't have the time for it in this short format podcast. But to the M&A Unplugged community, it's so important to reach out to people like Geoff, who's an expert here, understands what the market is for these sorts of indemnifications and what's appropriate, because you could really get hurt post sale if you're not careful about what terms and conditions get put into the contract ultimately. Geoff, I'm gonna move back over to private equity groups. I'm sure you've been doing this so long that there's very little that surprises you, but I'm curious, are there things when you're working with private equity groups where these are sophisticated buyers, right? They do lots of deals, they look at lots of deals, but are there a few areas where you still, even after all of their experience, have to like sort of talk them or walk them off the ledge? Or they get out over their skis, or they get over exuberant about a deal, and where are the things that that pop up where you have to really bring your private equity clients back to earth sometimes?
It's often difficult sellers and sellers counsel, where kind of like we are talking about on the indemnity, there's like bandwidths of what things should really be in, as far as, like, say, duration of survival of your representation. It's dealing with folks on the sell side that maybe don't know what they're doing, and they're just asking for things that are so far out of market that it really is a challenge to bring it back into a normal bandwidth. And the private equity folks can get fed up with that process pretty quickly. And so oftentimes I'm working with opposing counsel to try to draw them back into a more normal zone, and it can just be a real challenge.
Yeah, it really tests your legal skills, right? It goes beyond that. You become part, therapist and psychologist, right? And working through all of that.
Right. Or the sellers are not wanting exposure on a non-compete, which a buyer of a business, it's hard for them to tolerate that request that they not have, or have a very short non-compete, because from a buyer's perspective, I can't buy your company and then have you kind of go out and take it back from me. So expectations around some of those topics can get way out of whack.
Geoff, the information you shared today has been so incredible. We're going to wrap up here. Are there a couple of parting thoughts or comments that you would like to leave with the M&A Unplugged community?
Yeah, I'd say kind of start your thinking on a sale transaction early so that you can fix things that need to get fixed before it's too late to fix them. And then talk to advisors, accounting, legal, and otherwise that kind of know what they're doing and live in that space. You can make mistakes in both directions of either asking for things that are crazily inappropriate and you're never going to get, and kind of it can bog your transaction to a complete standstill, or you can be accepting exposures that you shouldn't be asked to accept, and you're just accepting them because the advice you're getting doesn't let you know any better. So my advice is start the process early and talk to people who know what they're doing.
Awesome. That's great. So my last question, Geoff, is there a book, whether it's business or personal, that you've read that, really resonated with you and you oftentimes recommend to folks?
The book I always recommend is less legal and more kind of business development oriented. I love the book Good to Great, which teases out some of the key characteristics of companies that really grow. And I've taken a lot of parts of that book and tried to implement them in my own building of my own practice. So whenever I'm recommending a book, that's usually the one I go to.
I got to tell you that book comes up at least 50% of the time when I ask people this
Oh,
question.
really?
It's unbelievable how often that book comes up. It's crazy, but it's a great book. I mean, there's just no denying it, right? So, Geoff, if people wanted to reach out to you and get in touch, how can they reach you?
My phone number, 312-849-8272, or you could shoot me a note at Cockrell, GCOCKRELL, at McGuireWoods.com, and that's McGuirewoods.
Geoff, it was such a pleasure to have you today. Thank you so much for joining us.
Thank you.
So to the M&A Unplugged podcast community, let me just summarize a couple of things that Geoff brought up today that really were such great takeaways. One, there is a difference between private equity groups, fundless sponsors or independent sponsors, and family offices, and understanding the differences between those is really important when you think about who is your ideal buyer based on the outcome that you want to see. It's also important to understand whether or not if you're going to be a private equity target, are you a platform or are you an add-on? And equally important to understand in all of that and know that the multiples that are going to get paid for a platform are completely different than for an add-on. And I know a lot of people get confused. They hear incredible multiples and they say, my neighbor or my friend just got this multiple for their business. But there's so much to know and so much that goes behind that. It's so important that you understand that, because if you're an add-on, you're not going to get anywhere near those multiples versus if you're a platform. And if you're an owner, thinking about selling, Geoff's advice around plan early. We talk about this. It comes up in almost every podcast about preparation and the need for proper preparation and pulling in the right advisors. Assessing your tax structure. It's not so much how much you get paid for the business, but how much you're going to keep after all is said and done. And making sure that your financial house is in order, not just your P&Ls, but also paying close attention to your balance sheet, because especially if you're a private equity target, they're going to want to take over a fair amount of your balance sheet. And so you need to understand what that is and have a clean balance sheet. And then the issues that go beyond price, which are like indemnifications, reps and warranties. And that's where having a great advisor like Geoff really matters, because they can coach you through, what is market and what to expect. I hope you enjoyed today's episode. All of the information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website, sunacquisitions.com, or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.